All right. Sorry for the delay and good afternoon, traders. Welcome out to the Tradespoon Active Investor Workshop Series today. Now, and I'll tell you this, these get scheduled. Vlad schedules these topics, sometimes just spacing them out, other times market specifically. But these will be an interesting one to present today. Just to give you a very brief introduction as to why, anytime you're dealing with any option strategy, you've got to consider implied volatility and its implications. And if you came to either trading room today, you know that implied volatility was an important characteristic of current market conditions that we emphasized. In fact, as we looked at the day in the morning, with the bullishness that we had in the morning, combined with a lack of decline in the implied volatility arena, it was unconvincing, right? In this circumstance, we're looking at the implied volatility as representative of institutional sentiment. What does it mean to us? It's staying high. The fear is staying high. Why is that important relative to spreads? Well, relative to any option strategy, because every option strategy has a Vega profile. Vega positive, Vega negative. The sign attached to Vega tells you what you want implied volatility to do. Vega positive, you want it to go up. Vega negative, you want it to go down. And so we have to be thinking about those terms whenever we're picking an option strategy. So right off the bat, a calendar spread is a Vega positive strategy. We want implied volatility to go up. What else is a Vega positive strategy? If you buy an option, buy a call, buy a put, we want implied volatility to go up. Diagonal spread, Vega positive. We want implied volatility to go up. If we want volatility to go up, where do we want it to start? As low as possible, right? That's the basic premise behind buying. If you buy a call, buy a put, buy a diagonal spread, buy a calendar spread, you're buying it, your preference is that it is cheap. And what are options right now? Not cheap. So you gotta be thinking about this, knowing that we're not likely to be putting these on right now. What spreads, what neutral spreads would we put on? Well, a couple of weeks ago, we had a conversation about butterfly spreads. And butterfly spreads and calendar spreads are very similar in that they are both delta neutral. We want the price to stay range bound. They're both theta positive. Time ticks in our favor. One is Vega positive, one is Vega negative. So opening screen and nothing else. This is all intro, my friend. We're just getting started. We're just scratching the surface. Welcome out to the Tradespoon Active Investor Workshop on calendar spreads. My name is Scott. I'm the head coach here at Tradespoon. I've been teaching for 20 years, trading for 20 years plus, teaching for over 17 of those. I do need to remind you that options can involve substantial risk, may not be suitable for all investors. Please read characteristics and risk of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risk, be willing to accept them in order to trade in these markets. Tradespoon and myself are not investment advisors, not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or will equal past performance. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin, interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and/or the team of Tradespoon may have a financial interest in the securities presented and the trade picks. Vlad Karpel, Tradespoon founder, is also an investor and consultant of AOS Inc., which does business as Trading Block and Money Block of FINRA, and SIPC member broker dealer firm, Tradespoon and AOS are not affiliated companies, and each firm's material is not endorsed by the other. Okay. Okay. So we're talking about calendar spreads. Calendar spreads on their face, I'm actually going to use a different symbol here. We'll go QQQ. Actually, I don't know. Maybe I will just use SPY, but I'll uncheck everything else to start fresh. So just to give you a quick background, okay? With any option strategy as you learn them, you're going to be paying particular attention to the Greeks. Delta, a little gamma, not as much. That's more of a minor. We're not going to think too much about gamma today. Theta and Vega. DTV, delta, theta, Vega. D, delta for dollar. How much does the strategy gain or lose as the price of the underlying stock goes up or down? Theta is time. How much do we gain or lose based on time decay? Vega is volatility. How much do we gain or lose as implied volatility goes up or down? Now, the strategy we're talking about, a calendar spread, falls under the family of what we would consider delta neutral strategies. Delta neutral. So over here, for delta neutral, we're this. It could go either way, somewhere in the middle. We can skew it a little bit up or a little bit down if we have a small bias one way or the other. But this is a strategy you put on when either A, you're feeling more neutral, or B, you're concerned about neutral. What would make us be concerned about a neutral market, right? That's going to be a good question for us to think about. I'll get there in just a minute. Let's finish this here. Theta is time. What do we want? Positive. Positive time decay. If you're not making money from direction, what are you making money from? Time. Time and maybe volatility, right? Now, for a calendar spread, what is the Vega profile? Positive. So we're neutral for delta, theta for positive for theta, positive for Vega. With IV being high, would this not be a good time to put on a calendar spread? So, as you're going to see here in a minute, when I build a calendar spread, you're going to notice that the Vega is actually quite large, but it's a positive Vega, which means you'll make money if implied volatility goes up, but you'll lose money if implied volatility goes down. So the problem with neutral, especially neutral to slightly bullish, meaning we think it's just going to kind of grind sideways or maybe go up a little bit, is that volatility might bleed off. Right now, if you look at our implied volatility, let's bring it up. That's certainly a relevant discussion here. When you look at the VIX right now, volatility is up at the high range. It's not as high as it could get, but it's up at the high range. If the market were to recover back, what would happen? This volatility would drop from 33 back down here to 20 or 18 or even down here to 17. So we'll look at what happens to a trade if that were to occur. If the volatility were to bleed off even half of it from 33 down to 25, right? So we'll look at what the implications of implied volatility would be after you put on the strategy. Yeah. Okay. So what makes us feel neutral? Well, first and foremost, where are we in the cycle of the year? We are in the summer months. If you've ever been here to research, you'll notice we have these seasonal charts, right? These seasonal charts come here, and you'll notice, what do we tend to see? We tend to see April going up, and then we get here to May, and May tends to just grind sideways all the way into June. Then in June, reset Zoom. Then in June, it tends to pull back, get a little bounce, and then August, September, October, more sideways. So there's a lot of sideways price action projected for summer months. You've probably heard the term sell in May and go away. Okay, well, that's where it comes from, right? That is where it comes from. All right. Let's talk about where else we might get some ideas about possible sideways action. What makes us believe the market is going to go sideways? Well, if I have a cyclical showing sideways and I come and I look at my range trend and it's neutral, and then I come down here and I look at this and I say, well, that's mostly sideways. Mostly sideways with a little bit of a turn. I've got most of the conditions in place. The sideways is there, right? The sideways is there. We've got a neutral projection from multiple sources. What's the only problem we have? The only problem we do have is the volatility is a little high. It's not cheap. My preference, just so you have a sense of it, my preference for calendar spreads is a VIX below 18. What's the problem with that? Well, since the pandemic, we have come down and we've gotten as low as 15. We actually did quite a few calendar spreads last year during this time, quite a few. And we made money on probably 80 to 90% of them. Because when you do them right, and when you do them in the right market context, they are flexible, they are adaptive, and they are high probability, right? Flexible, adaptive, high probability. Directional trades are never flexible or adaptive. Only these neutral trades have those qualities. What does that mean? It means we're probably not going to get a huge reward to risk ratio because the probability is high. But we want to make sure that we go into any strategy with appropriate expectations, right? We definitely want to have appropriate expectations. Now, make sure you feel comfortable asking questions as they go along. I'd love to hear from you as we go. So let's talk about building this, right? 2 contracts are involved. I'm buying one and I'm selling one at the same strike price, different expirations. That's why they call it a calendar spread instead of a vertical spread, right? A vertical spread, same thing. You're buying one, you're selling one. I've got bull call, bull put. I've got bear call, bear put. I'm buying one, I'm selling one. One is a debit, possibly. One is a credit, possibly. Those are vertical spreads. Why vertical? Because the strikes are on top of each other in the same expiration. So they're up and down. What's up with this one? Different expirations and the prices are the same. Or a diagonal. Ed said a diagonal is kind of a hybrid of the two. A diagonal is going to be different strike prices and different expirations. So when dealing with butterfly spreads, we can take them from neutral to more directional by making them a broken wing butterfly spread. When dealing with calendar spreads, there's no broken wing calendar. It's a calendar. But to get more of a directional bias, you would consider, instead of a calendar, you would look at a diagonal. A diagonal is going to give you more of a directional bias. But when it comes to the calendars right now, we're only thinking neutral. Now, volatility is not ideal, but we're going to build it anyway. What are we looking to do? We sell the front month option. Why? Why sell front month? Because a 2-week option is going to decay at a faster rate than a 4-week option. It's that simple, right? The positive theta you get for selling the short-term option is greater than the negative theta you buy from the longer-term option, and that makes it theta positive. The vega of the option that you sold is going to be smaller than the vega of the option that you bought, because vegas are higher at further out expirations. Therefore, it's going to be a vega positive strategy. And depending on where you put it, right? So let's go look at SPY, and we're going to do a live example. I mean, this is hard, right? This is hard because at this point, we are just flirting, knocking, testing. If we go off the SPY and we say 479.98 and we say times 0.9, that's a correction. The correction occurred at around 432. That was back here in January, and again several times through here. We've already had the correction. It's a technical term. 479.98 times 0.8. 0.8 is a 20% retracement, with 20% retracement being bear market territory. 384. 384. Where did we get today? 394. We got to 394. We're 10 points away. 10 points away from a bear market, but we're certainly moving in a bearish fashion. Question came in a high implied volatility environment, such as we have, would it only make sense to do put calendars, as we are hoping for a further increase in IV? Great question, Ed. Very good question. But to be honest, the differences between put calendars and call calendars are negligible. Same thing with put butterflies and call butterflies. And I'll show you this here in just a minute. I have a tendency to build put calendars and call butterflies, believe it or not. And it's just a matter of preference. Like I said, if you're like, what? I only ever do put calendars or call calendars. I mean, it's negligible, right? I like to be able to stack them. There are times where I'll start with a calendar spread, and then the market drops and the volatility rises, and I think, you know what, I'm going to connect this to a butterfly. Or there's times where I start with a butterfly, and then the market rises and it gets to the other end of my butterfly, and I say, you know what, I'm going to balance this now with the calendar, because what's happened is if I start with a calendar and the market drops, the volatility's helped me, but the price has hurt me. So now if I can put something on to kind of lock in that volatility gain, then I can just allow it to stay range bound. And I'm looking for things to stay range bound most of the time. That's the thought process. So great question. I hope that answers the question for you, but I do have a tendency to put on puts. Now, remember though, we're not hoping for a further increase in IV. Oh, I'm sorry. You're right. No, you're right. Yeah. You said that exactly right. We would be hoping for a further increase in IV, which is what makes it difficult to put it on when we have an IV in the 30s, right? Because an IV in the 30s, for IV to go higher than in the 30s, you're talking about spiking to the 50s. And if the IV spikes to the 50s, prices are tumbling, right? They're falling hard. So we have to be careful with that. Okay, so now, what is the basic premise? At or near the money, you're going to sell the short term, buy the longer term. It's that simple. So just to get one going here, I'm going to look at the May. I'm going to look at May. It's not quite 2 weeks. So I'm going to look at a 2-week, 4-week calendar, and then I'm going to look at like a 1 month, 2 month calendar, and I'll show you kind of how they look differently from each other. So the first one I'm going to do is going to be the 20th and the 3rd. So I'm going to come here. We'll go right at the money, which is 400. And I'm going to go May by June 3rd. And here is what it looks like. So you'll notice, what do I have here? I've got this triangle shape right here. It dips on either side. Oh, it's not great. In a lower implied volatility market, this would start maybe here and then go up to here and then back out. A much steeper in the middle and much more shallow on the outsides. So what do I have here? Well, if you look at my Greeks, what do I have here? I have delta. What do I want it to do? Stay right where it is, delta of 7. If it went up, it would be barely. If you watch the delta right there, that's it. At 400, it transitions to negative. The more it goes this way, the more I want it to come back. The more it goes this way, the more I want it to come back. So the higher it goes, the more negative it gets, because I want it to drop back to the middle. The lower it gets, the more positive the delta gets, because I want it to get back up to the middle. Where are we starting now? Close to the middle. That's my delta neutral. So where do I make money? Well, here's some money. Theta. I make $196 per day. Today I make 196. Tomorrow I make 196. Then the next one I make more and more and more. And you can see as time ticks. So let me go back where I was. I want you to see this clearly. If you're watching here, as time ticks, that's where I start making money. There's the 185, now to 400, 637, 907. Then we get to the weekend. Where's the weekend? The weekend is the 14th. So we get here, and then all of a sudden we get Saturday, Sunday, and by the time Monday comes, this thing's up at $1,600. If it does what? If it stays between about 385 and about 415. So with this being a 2-week, 4-week option, this is a very short-lived trade. I'm not looking to push the envelope here. If it got to Tuesday of the next week and I'm somewhere between, here I'm making 900, here I'm making 900, so somewhere in between 390 and 410, this trade should be making upwards of $1,500. Now you might ask, well, what happens? Well, let's finish the Greeks, then we'll talk about the what ifs. Let's finish the Greeks. Vega. It's smaller. Let me go back to today, to the start of the trade, but not by much. So if implied volatility, if this were to go up, and this is where it's dangerous. If this went up here to 420, you might be thinking, oh, Scott, if it gets to 420, you're losing $800. And I'd be like, yeah, maybe worse. Why? That's a 5% increase on the stock, right? 5% increase. If the stock increases 5%, that's like from here to here. What does the implied volatility do? It drops from 21 to 17.5. That's 4.5 points. Where we are now, though, we could see it potentially drop 10 points of volatility drop. Is that going to help us or hurt us? I'm going to say it's going to hurt us. Now, as I'm clicking this, what I'm doing is I'm injecting implied volatility into the model. Remember, our assumption is that this thing is moving out here, up, and implied volatility is moving, sorry, I meant down. If implied volatility goes up, if stock price goes up, implied volatility is going to go down. If volatility increases on a Vega positive strategy, this line is going to move up across the board. If, however, implied volatility comes down, it's the opposite. We're going to see this, not there. We're going to see this dropping. VIX equals IV or stock price change. The VIX is IV, right? It is the implied, it's the standard. It's the implied volatility standard. So it is looking at implied volatility on the S&P 500 index options, which is what the institutions tend to use to hedge, which is why I find it to be so very useful. Great question, Teresa. Thank you. Now let me show you what happens. How does this trade money? How does this trade make money? If time ticks, we make money. You can see it going up, right? However, if time ticks and you're outside of these areas, it will hurt you. So if you notice, if I go out here, theta is going to start to hurt me a little bit. Well, it takes a little while, but it's going to hurt me. Same thing over here to the downside. Stays fairly theta positive for a while, but ends up hurting me eventually. Now, if I start to decrease volatility, what's going to happen? You'll notice, and it's not just the purple line, it's the whole trade. The whole trade is shrinking. Remember what we said, it could go from 33 back to 20. That would be a 15% decrease in implied volatility. Are you seeing this? You see how nasty this is, right? And there's 13%. It takes this whole trade and just sucks it underwater. Just suck all the way down. This is why we cannot put this trade on during periods of inflated implied volatility. When do I put this trade on? When implied volatility is low. It's way too sensitive. How sensitive is it? It loses $150 for every 1% implied volatility drops, and we think volatility could easily drop by 10 if this thing goes wrong. I don't want to have to overcome $1,500 of volatility decay if I'm only going to be in the trade for 7 to 10 days. Everything I make on Vega, theta, I lose on Vega. So hopefully you're seeing as an options trader the importance of connecting the dots in this strategy. Carmen asked a great question. She says, Scott, why not just do a simple put or a call? Well, here's why. If you're doing a simple put, it's because you think that this is dropping. If you're doing a simple call, it's because you think that it is rising. What is this strategy for? What if you think it's in the middle? And to be honest with you, if we're in a bull market, calendar spreads actually work quite well with directional trades. Here's the flow. You would be looking to put bullish trades on when the market was at support, calendar trades on when the market was at resistance. You get bullish, it goes up, 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 up. Hits resistance. What do? Put a calendar spread on, and then if it pulls back and then bounces again, you're making money from time. If you buy a call or a put, you're directionally biased. Your delta is going up or your delta is going down, which means if it does the opposite, it's just simply a loss. Time is always ticking, so we know that. But remember that a simple call or put requires a directional bias. What if you don't have a directional bias? This is a little known stat, but markets typically are only trending about 30% of the time. The other 70, they're correcting, crashing, or consolidating. We'll see a lot of consolidations. So certainly there is that. And without a doubt, Carmen, it's more simple to simply trade up or trade down at resistance or support. But imagine yourself in a bullish market. Market goes up, you make money, then what? It hits resistance and you get out and you wait. Could you trade bearishly? I mean, you could. I have a trading rule that's very helpful that says I don't buy weakness and I don't sell strength. So I want to be careful not to fall into that category. So good question though. I appreciate that. Now, what can I do? Well, if it were to come out to one way or the other, I have the ability to extend it. And if I extend it, it looks something like this. This is a double calendar. Some people will call this a double diagonal, but you'll notice it's basically if it stays somewhere between 390 and 430, I'm gonna be fine. I'll be able to see what's going on with it. I've got plenty of width. I mean, 390 to 420, 430, that's 40 points. That's 10% on the index. 10%. Yeah, these are very mellow strategies. So this is a shorter time decay. I want you to notice the delta is a little more muted. Theta is bigger, Vega is bigger. I'm going to show you now, what if I were to go further out in time? What if I went out and I did June, July? So I'm going to do June 17th. June 17th, that's my brother's birthday. Watch out. June 17th by July 17th. So I'm not going to keep that default. We need to have that ability to have time in between. I don't want that one. Okay. Now this one is quite a bit cheaper, but here's what you'll notice about it. It's also smaller. The delta is very neutral, hardly anything at all there. The theta has been cut in half, right? 30, we have a theta of 21 versus a theta of 195. What does that mean? It means that I'll make money faster with the shorter term trades. That's one of the reasons I like them. But they're also a little harder to control. So if you're looking for a little more control in what we're doing, then going further out in time will make more sense, right? It's the same thing with credit spreads. We get caught up in, oh, I want the theta. I want to make my money as quickly as possible over the next few days. Well, I want to control my risk. So you've got to decide which is better, a fast theta or controlled risk. If it's fast theta, then great. So there you go. Okay. Now, let me know if you have any questions yet. June 3rd, May 2nd, June 3rd, May 2nd. Okay, this is June 17, July 15. Yeah, okay. Okay. So what do I have here? My theta is actually pretty close. Now I want you to notice on the shorter term option, my theta is bigger than my vega. As I get further out, my theta is a third of the size of the vega. Why? Well, because it becomes much more sensitive to changes in implied volatility the further out you go. Is there gamma risk? Oh my God, Ed, what a phenomenal question. Is there gamma risk? And if so, how many days prior to expiration should this trade be executed? Yeah, there can be. You'll notice the gamma is very small, though, right off the bat. It will increase over time. So you can see that the gamma is getting worse as we get into this trade, but it's never really terrible. But it's typically, if I'm doing a 2-week, 4-week strategy, I'm starting the trade in week 1, thinking about adjusting it at the end of week 1, early week 2, closing it middle of week 2. If I'm doing like a 1 month, 2 month, like 5 weeks, 9 weeks, or 6 weeks, 10 weeks, there's a little bit more leeway. There's more you can do, but yeah, that's the general premise of what I'm looking for. All right. All right. That's the gist of the strategy. What is gamma, John said? Great question. Gamma, a lesser known Greek, is the delta of delta. Delta is delta. So delta as a mathematical concept is rate of change, right? How much will the option change as a rate relative to a movement in the underlying stock, rate of change. Gamma is going to tell us how fast does delta change. You'll notice that in this strategy, we start with gamma delta here, and it goes all the way up to 250 and all the way down to 330. Because in this situation, this one is much more sensitive, right? This is much more sensitive. You can see this one is a gamma of 50, whereas this one here, there's got to be one, right? What am I missing? Oh, it's the date. Go to today. So here the gamma is 2. I must have been missing something. It was off. Oh, it was off because yes. So there is your gamma risk, Ed. It definitely is going to be in the last week, right? So if I start to go through this, you'll see that as time ticks, gamma gets worse, right? And you'll notice it reset here. It got to about minus 40. Then what happens? Well, if I keep advancing my trade, the May 20th option has already expired. So that's not necessarily helpful to me. So gamma is how much will delta change? How fast will delta change? Gamma risk typically is the highest in the last week of an option. Great questions. I appreciate the participation. Hopefully you're kind of seeing now, how does this strategy fit? You're never going to make your living just, well, I mean, you can actually do quite well. There is quite a bit of potential in these in a low vol environment, because in a low vol environment, it's difficult to make money from time decay, right? In a market like this, we can get time on our side. In a low vol market, the volatility is it's harder to squeeze it into our favor. So in that regard, a calendar works very, very well playing with others, meaning it leapfrogs with directional trades. I'm bullish overall. I'm going to make more money bullishly, but at any given time, the market is going to be very much a determining factor as to which strategy we're more inclined to trade. Question came in, said, I understand we can make more money in futures with less. Is that true? Well, yeah, right? Because futures are leveraged. Futures are leveraged. Options are leveraged. Anything leveraged will have that ability. Let's see a call one. Teresa said, beautiful. Beautiful. Let's do it. So if all I do is change call and put, yeah, 850. So let me highlight this. What does that mean? Leverage, more with less, right? I'm taking like a lever. I can put it to a boulder and move the boulder because I'm getting that leverage of that. So I'm able to get more for less. So for example, if I wanted to control the S&P 500, I could buy 100 shares of SPY. That's going to cost me $40,000 for 100 shares. Or I can buy an option and control that amount. Or I can buy a futures contract and I can control it. So I'm using leverage to control the underlying without having to buy the underlying. If I have to buy the underlying, it's going to be much, much more expensive. So leverage is my ability to take a trade in a way that makes as much money as if I had bought the stock, but I didn't actually have to buy the stock. That's what's happening. Okay, so now let's there. 8, 196, 144, right? 8, 196, 144. 8, 197, 144. This is calls, this is puts. Calls, puts. Calls, puts. Which looks better? One, oops, I'm not sending that order. 1 or 2? 1 or 2. They're basically the same thing. That's why I say they're basically the same thing. Now, there has been a unique situation where the market went up, which is the most dangerous thing. If the market goes down, I'm going to hang on to it and maybe add to it. If the market goes up, I'm going to add to it at least once, but I can usually only add once and then I get a little bit stuck. It's something that, you know, if we're planning on this, remember that if the market's going higher, volatility is dropping. Even if it's not dropping very much, it's still going to hurt us a little bit. Go back to check the cost. Okay, the cost of the call calendar, 346. The cost of the put calendar, 334. So it is a little bit cheaper, but that doesn't actually necessarily mean it's better. They're just simply different. Okay, that's the gist of it. What are we doing here? If we're neutral, if we're worried about neutral and we have directionals and we need to balance it out, there's nothing worse than having a bunch of directional trades on and watching the market grind sideways. And you're just kind of pissing money, right, into the wind to some extent. Sorry, that was a little crass. I didn't mean for it to be. Kind of slipped out on me. But you are, right? You're just kind of grinding your wheels. You're not making any money because your directional trades aren't going anywhere. Diversification as an options trader is not through what stocks, but through what strategies. I diversify by having on some bull put spreads combined with some calendar spreads, and they all make money from time and they work well together. That's what I'm looking for. So I love calendars and butterflies. I think that everybody who trades options should get comfortable learning how to place delta neutral strategies unequivocally. That should be something you do. You are missing on such an important and prevalent piece of the market if that happens. So just definitely be aware of that. All right. So butterflies in the higher volatility, calendars in the lower volatility. Can I connect a butterfly to a calendar? Yes. Can I connect a calendar to a butterfly? Yes. Can I connect two calendars to each other? Yes. Can I connect two butterflies to each other? Yes. If I put this calendar spread on and the market dropped, I would be looking to add a butterfly because the volatility has risen. If this were to go up, I would add another calendar. Can I explain delta neutral again? Yes, absolutely. Delta neutral. A delta close to zero. The more bullish you are, the more your deltas will get positive. If you were to look at the delta for a bull put spread, bull call spread, buy a call, it's going to be much, much higher, which tells us you're making money from direction. Or if you were to think it's going to go down, you would be vague and negative. What does that mean? It means that I'm worried about the price of the stock dropping. So what is delta neutral? Delta neutral, you can see here, this is my range. I want it to stay. I don't want it to go up. I can do okay to here. And I don't want it to go down. I can do okay to here. But for the most part, where do I want it? The closer to the middle, the better, delta neutral. Now, if you're, more directionally biased, meaning you are bullish or bearish, then you do want more delta positive or more delta negative. This is a balancing strategy, a hedging strategy. I'll tell you right now, there's been times where I've had 12, 14-week streaks, calendar after calendar after calendar. It's like cha-ching, cha-ching, cha-ching. If we get back into that environment, trending low volatility, that is by far my most favorite market to trade. I will trade directionally at bullish instances. I will put calendars on at bearish instances, and I will definitely be, pushing along those lines. Okay, did I get everybody's questions answered? Let me know if not. Again, great strategy, not necessarily great now, but it is definitely something that as an options trader you want in your repertoire, right? You want calendars, you want butterflies. You don't need iron condors. These are actually replacements for that. You want directional spreads, bull call, bull put, or bear call, bear put, and you want to be able to trade directionally yourself. So there you go. Bears repeating over and over and over. I agree 100%, Carmen. Never go over it. It's funny because I remember that was actually a very difficult concept for me when I was first learning options. I'm like, what the hell do you mean delta neutral? What do you mean? So good. I'm glad I could help clarify that. So yes, if you come to the trading rooms and the volatility bleeds off back down into the teens, you will see us placing these trades over and over and over again. If you see the volatility staying in the 20s and 30s, then you have to be careful. Ed says, if you have a slight directional bias, do you place your strike at that point, or do you always? No, that's exactly what you do, Ed. Great question. Let me bias it real quick. Super easy, right? So if it's 400 and I think, you know what? I think we're going more towards 405 or 410. but I don't see it really bullish. I see it more neutral. What do? I take this and I go to 405. And now what you'll notice is, watch what happens. My delta is going to get more positive. Now my delta is 32. It's less neutral. It's more positive. Why? Because I want it to go up. If I take this to 410, even more delta positive. I still have positive theta and positive vega, but you'll notice I need it to go this way now. If this is where I am, I don't have a lot of leeway, but you'll notice this looks like an okay trade. If it were to move up and then just grind sideways, this trade would actually start cranking some profits. So if I were to say to myself, you know what, if it turns out great, but I'm going to stop out down here, I'm risking about $500. A week from now, I'm making more than that almost everywhere through this range because theta is as high as it is. So great question, Ed. I hope that clears it up. That now, if you start to get too much of a bias, then you would ask yourself, why am I not just buying the call here? Oh, Carmen, you and me both. I'll tell you all the time. You'll hear me talk about it. My ADD kicks in, and all of a sudden I'm talking. I'm like, how did we get talking about this? And what I like to do is I like to blame the room when I get distracted. It's terrible, I know, but I do it anyway. Well, listen, guys, I appreciate you coming out and hanging out with me on this fine Tuesday afternoon. I would like to invite you to come out 2 weeks from today. I'll be back. I hope you are too. I don't know what we're talking about, but usually it's pretty good. So come out, hang out with me, and we'll see what we can talk about. Thank you, Ed. I appreciate that. Thank you, Teresa. I appreciate the energy you guys bring and the questions. It makes it easier for me. So if you're in the trading rooms, Vlad will be back tomorrow morning. I'll be my usual tomorrow afternoon. How do you watch the recording? John said, let me show you that real quickly. He snuck it in under the wire. If you come under quick navigation and you go to event recordings and you come here to active investor workshop series, you'll notice the last one says weekly versus monthly options. That's not what we talked about. We actually talked about how to develop a market posture. That's one of my most favorite things. So if you missed 2 weeks ago, go back and watch that one because I think that one's worthwhile. And if you go 2 weeks prior to that one, what do you know? Profiting with butterflies. You're going to see a very similar discussion to the one we just had, but with a lean towards a starting point with high volatility, expecting it to diminish. Good stuff. Take a look. Have a wonderful day. See you tomorrow. And as always, happy trading.